Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast presented as always by Tusk Media. Real quick, do us a favor, go to youtube.com/Tusk Media LLC. That's where you can watch all of our archives. We actually just launched a brand new show. It's kind of in beta testing right now called Young Bucks. It's all about money and investing for young people. So check that out. Do us that favor. Also check us out on Twitter, twitter.com/Tusk Media LLC. Same place on Facebook, facebook.com/Tusk Media LLC. Andrew Hall here joining me today. Ben Nye. Ben, how are you?
I'm doing well.
Good. Doing maybe a little bit better than Disney right after earnings. We're here to kind of talk through this. We're shareholders in Disney, and everybody always criticizes us for talking our book. And here's a great case where maybe we wish we didn't own quite as much Disney. But Disney, kind of a rough quarter. Talk to us a little bit about headlines.
Yeah, so they hit the studio numbers pretty well. They hit the parks numbers pretty well. But on the media side, which includes the cable business, and it also includes the broadcast business, the ABCs and the like, that just blew it again. And it seems like we've been talking about the decline of ESPN for years now, but it just doesn't seem to end for them. So unfortunately for them, they had a big miss on the cable networks, specifically on the operating profit line. They hit $1.46 billion in operating profit, which sounds like a lot, but analysts were looking for $1.59 billion. Obviously, this year had a tough comparison because they didn't have all the NBA playoff games that they had last year. It wasn't as compelling. Nevertheless, a weak result for them. They're also not getting traction on ABC that they have been getting in previous years. And when you think of the franchises they had in the past, and you look at the lineups this year, for instance, and NBC has more higher profile shows and other channels like CBS, and then of course you have all the competition with the likes of HBO and Netflix, and it's just increasingly crowded there, and Disney just can't get it right on that side of the business yet.
Yeah, they've really kind of continued to struggle, and it's really frustrating from an investor standpoint because they're missing, and I would argue, I think most people would argue, the stock price certainly would suggest that they're missing the most crucial component where people are really looking for things to be rectified on that network television side of things, and it's just not happening. And so it's already under the magnifying glass. I mean, you mentioned some of the comps, the challenges of not having as many NBA Finals games, things like that year over year, but at the same time, that's something of a known quantity, and analysts still are hoping for more, right? And so it's kind of right in the crosshairs of what they're missing right there. As you look at that, especially with ESPN, that's a well-known problem. We've talked about it a lot on this podcast before. They've started to throw out, kind of some new ideas and some solutions, but really, where do they go from here?
Yeah, so their big new solution is this new digital platform at ESPN. This is going to be a lot more than Watch ESPN. This is going to be its wholly owned, separate subscription channel. They're adding 10,000 additional live events to what is already available. And to my mind, I think, either, and probably more likely, this is not going to be very compelling content. It's going to be primarily college content, but what is the audience for that? In terms of, you're looking at small college events, obviously. Or you're paying a ton of money to get 10,000 really high lucrative events, which I think it's difficult to find 10,000 of anything that's really high and prestigious and lucrative. But to the extent that some of these events are, that's going to cost, again, more money on the content side. And really, can they make that on the back end with subscription sales? I think that's a tough ask for them.
Yeah, it's kind of one of those big sexy numbers that if you don't think about it, you say, oh wow, 10,000 more sporting events, every single day. That must be phenomenal. But really, you're talking about 30 live events per day over the course of a year that will be additional, and you kind of take a step back and say, well, what could I previously not watch?
Yeah.
And you really do. You get into the things where, hey, if there's a market and a demand for this, guess what? You can find a lot. And now it's starting to get a little bit questionable. They've also made some adjustments with some of their, more prestigious content in terms of what they're going to allow going to Netflix. They're making a big move from that Kind of an interesting strategy, it seems like, there in terms of saying, hey, Disney content, it's not going to be available on Netflix. From my perception, I don't think it's a bad move. I think it's an interesting move. I think with ESPN, you saw just a colossal mismanagement of the transition away from traditional cable provider models, and they've been behind the 8 ball. And this almost seems like them trying to be one step ahead of that movement and say, no, we want to make sure we're controlling as much distribution of our content as possible in the future. And because it's one step ahead, it almost seems a little bit desperate or premature, but might be the right move. Do you have any thoughts on that?
Yeah, it almost seems premature and at the same time too late. It just seems at a weird time to do this. Why would you do it now when you're still getting paid by Netflix pretty well? And why didn't you do this in the past if this was an option? So, to give you a little backstory, ESPN, that launch is coming in 2018. The Disney Channel, Disney Digital, let's call it, is coming in the second half of 2019. And all that Disney content and Pixar content will be pulled from Netflix at the beginning of 2019. They have not said whether they're going to also pull the Marvel or the Star Wars films, but that's up in the air right now. Just in terms of how this platform is going to look, they're going to add content. So if you are subscribing to this Disney digital service, you'll get all the new movies. It'll automatically appear. You can just watch all those. You can watch all the old films. And they'll also come out with new and exclusive content specifically just for Disney Digital. And for that, they're going to essentially double the amount of content that's created out of the Disney and Pixar studios from, if they're doing 10 films now, which on average they're doing about that. So then you're talking about 20 films. But again, you think about what is a Disney brand and the potential dilution. Already we've seen some of this with Marvel. I think that everyone was really excited about Marvel, the first few films that were released. That excitement has faded. They just continue with new superhero after new superhero, and you can't really keep up. Mm-hmm. At least I can't. Yeah. So it's an interesting strategy where they are almost pursuing the Netflix model of just getting as much content out as possible and relying on their historical creativity to compete there. But Disney's real niche, in my opinion, is creating that really valuable, unique content that you can't find anyplace else. And to me, I think that's going to be difficult to do.
Yeah, as you look at their outlook, it seems like we're kind of looking at an odd juxtaposition between not just who Disney was and who they want to be or who they used to be and who they're going to be, but it's like both in the past and in the future, you kind of have this weird juxtaposition between kind of premium prestige content. On the sports side, I think of things like, Monday Night Football, one of the most expensive programs on television, obviously very valuable live rights. Then you contrast that with saying, hey, we're going to bring you 10,000 more. We're going to bring you Division III women's soccer whenever you want to be able to watch it. We're going to have that live. So you have that, and then you also on the film side, you have the Disney Vault, in which they take classic Disney movies and just basically make them unavailable, juxtaposed with, hey, now we're going to make 20 movies a year instead of 10. We're going to double the amount of content coming out. We're just going to flood the market with it. So it's kind of almost a little bit of an identity crisis in some ways. As you look at them moving forward, what are some of the challenges and opportunities? What's your general outlook?
Well, this is all happening in the midst of uncertainty whether or not the current CEO, Bob Iger, actually leaves or not. He's postponed retirement, I think, twice now. So you also have that in the background as well. In terms of the medium term, in 2018 and 2019, I expect that the costs continue to be very high on the content side. I know you don't have the year-over-year comparisons with the NBA contract anymore because now that's happening. But you're going to have all this additional content that you're going to be paying for. So I think that it takes a while, if that J-curve actually manifests itself, I think that takes a while, and we probably won't see that until 2020. So the EPS side for Disney, I think, is uncertain. I think this new strategy adds to that uncertainty and the risk. And we will see what happens, but I am less of a fan in the near term than I was prior to the strategy announcements.
Yeah, I think we're kind of all in agreement here internally. I mean, we are holders. I think we're continuing to hold. We're certainly not selling because of earnings, but we're certainly watching the outlook, and I think execution really comes to the forefront as you start to look at this, because although we may not see the 2018 and 2019 stories play out now, if we continue to see mismanagement on big properties like ESPN, smaller steps, it's going to be harder and harder to have a lot of confidence in what's going to happen 2-3 years down the road. Stay tuned. The Investing Podcast. Check out all our stuff on Seeking Alpha. Hit subscribe on YouTube, all that good stuff. We will talk to you soon.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.